Please stand by. We are about to begin. Good morning, ladies and gentlemen. Welcome to J.P. Morgan Chase's second quarter 2016 earnings call. This call is being recorded. Your line will be muted for the duration of the call. We will now go live to the presentation. Please stand by. At this time, I would like to turn the call over to J.P. Morgan Chase's Chairman and CEO, Jamie Dimon, and Chief Financial Officer, Marianne Lake. Ms. Lake, please go ahead.
Thank you, and good morning, everyone. I'm going to take you through the earnings presentation, which is available on our website. Please refer to the disclaimer regarding forward-looking statements at the back of the presentation. Starting on page 1, the firm reported net income of $6.2 billion, EPS of $1.55, and a return on tangible common equity of 13%, on $25.2 billion of revenue, a strong result this quarter, particularly given the backdrop. And while there are no significant items shown here on the page, our underlying performance was even stronger if you exclude the impact of other notable items, primarily credit, legal, and tax, all of which you'll hear about as I go through the presentation. And that strength was driven by increased client trading activity across markets and an improvement in IB fees compared to the first quarter, as well as strong core loan growth of 16%, reflecting good demand across both consumer and wholesale, and record consumer deposit growth up $54 billion. Before I go through the results, let me spend a moment on two topics that are top of mind. First, an update on wholesale credit. You will see that the total wholesale credit costs this quarter were approximately $200 million. Within this, charge-offs of $150 million were principally driven by oil and gas and metals and mining. And those charge-offs were very substantially offset by reserve releases, so they were previously reserved. Which means that underlying the net $50 million reserve build, we saw incremental reserve actions this quarter of about $200 million, principally one energy name downgraded in the CIB. Although the oil and gas sector remains stressed and reserves will continue to be idiosyncratic, overall trends have been somewhat positive, with oil prices continuing to stabilize and firming sentiment in the sector improving access to capital markets. In addition, outside of energy, we still have not seen contagion or deterioration in our wholesale or consumer credit portfolios. Second, on Brexit, uncertainty running up to the referendum led to a risk-off environment, and following the decision, the markets were quite volatile as expected, and volumes were materially higher in the immediate aftermath. The market functioned quite well, absorbing the volatility, and despite the significant increases in volumes, our systems were stable, and we continued to support client activity with decent trading performance. With respect to next steps, as you know, the ultimate relationship between the UK and the European Union broadly, and access to the single market and passporting specifically, will likely unfold slowly and over an extended period, depending on when Article 50 is invoked. We continue to work on plans for the full range of outcomes, but we will be appropriately patient. The most important point is that we remain committed to fully supporting our European and UK clients across businesses, and we will be fully able to do this. And while executing against certain of these options would be complex, ultimately we will protect the franchise and minimize any friction costs so that they will be manageable for the company. Moving on to page 2. Revenue of $25.2 billion was up $700 million year on year on higher net interest income. For the full year, expect NII to be up more than the $2 billion we guided at Investor Day, despite headwinds from a flatter yield curve. Given that our sensitivity is significantly skewed to the front end of the curve, and as industry deposit reprice to date has remained low, coupled with continued strong loan and deposit growth. Non-interest revenue was flat year on year, with the increase in markets revenue being offset by declines in IB fees as well as asset management. Adjusted expense of $14.1 billion was down $140 million, reflecting continued progress against our commitments. We still expect full-year expense of $56 billion plus or minus, as the second half of the year includes our expectation of an increase in the FDI surcharge in the third and fourth quarters. Moving on to capital on page 3. The firm's advanced fully phased-in CET1 ratio was 11.9%, with standardised at 12.1%, both up about 15 basis points from the prior quarter. The improvement in both ratios was driven by net capital generation, with RWA remaining relatively flat. Firm SLR remained flat to the prior quarter at 6.6%, as capital generation was offset by balance sheet growth. This quarter, we returned $4.4 billion of net capital to shareholders, including $2.6 billion of net repurchases and common dividends of 48 cents a share. Finally, we're pleased we did not receive an objection to our capital plan, and the board authorized gross repurchases of up to $10.6 billion. Moving on to page 4 and Consumer and Community Banking. Consumer and Community Banking generated $2.7 billion of net income, with an ROE of 20%, reflecting continued strength in business drivers. We had record deposit growth again this quarter, up 10% year on year. Average loans were up 11%, with core loans up 23%, driven by mortgage and auto, but with continued strength across all products. And we had record business banking loan originations of $2.2 billion, up 14% year on year, and with a strong pipeline, up 17%. We added nearly 2 million households year on year, with an increase of 700,000 since last quarter, reflecting strong acquisition trends, including the launch of Freedom Unlimited. And finally, our active mobile customer base remains the largest among US banks, up 18%. Revenue of $11.5 billion included some non-core items which contributed a little under $200 million. Principally, a one-time gain on Visa Europe and negative mark-to-market on Square. Adjusted for this, revenue was up 2%. Consumer and business banking revenue was up 3%, reflecting strong deposit and account growth. Mortgage revenue was up 5%, with rates remaining low supporting production margins, and on growth in NII as we added $14 billion of high-quality loans to our portfolio this quarter, partially offset by lower servicing revenue. Card, Commerce Solutions and Auto revenue was up, but flat if you exclude the non-core items I mentioned, with growth in card and auto offsetting the impact of card renegotiations. Expense was down 3%, driven by lower legal expense and continued progress against our efficiency commitments, allowing us to fund the incremental marketing and auto lease growth that we talked about at Investor Day. Finally, credit trends across the consumer businesses continue to be favorable, with charge-offs in card trending up slightly. Over the last 2 to 3 years, we have responsibly expanded our credit box in card, in the prime and near prime space. As these vintages season, we would naturally expect a higher loss rate, and performance is in line with our expectations. These loans are coming on at ROEs higher than the portfolio average. So as the mix of our portfolio increasingly reflects these newer vintages, we do expect loss rates to continue to trend up, but to do so slowly. And as such, we built $250 million of reserves this quarter. Moving to auto credit, competitive pressures have caused some lenders to take more layered risk. We have maintained our underwriting discipline, with average FICO scores and LTVs better than the industry, and with a very sharp focus on avoiding risk layering. Our credit performance is in line with expectations, and we built $50 million in reserves this quarter, largely reflecting volume growth. Against these reserve builds, we saw releases of $125 million, principally driven by mortgage. Turning to page 5 and the Corporate and Investment Bank. CIB reported net income of $2.5 billion on revenue of $9.2 billion and an ROE of 15%. In banking, IB revenue was $1.5 billion, down 15% in a market down 18%, largely driven by lower equity underwriting fees. We maintained share and ranked number 1 in global IB fees, ranking number 1 in North America and EMEA. Advisory fees were flat versus a wallet that declined 15%. This quarter, we ranked number 2 globally and grew share by 50 basis points. In equity underwriting, global issuance improved after a weak first quarter, but was down from a strong quarter last year, with fees down 37% in a market down 42%. We continued to rank number one globally, growing share by 30 basis points, and we ranked number one in every product category for the first half of this year. Debt underwriting fees were down 2% from a strong prior year, largely in line with the market, which was down 4%, and we ranked number two globally. Moving on to the outlook for fees, given the decline in M&A volumes, lower wallet is expected in the second half of 2016. We expect to see positive momentum in ECM as the new issuance market continues to improve, and we expect